With all the buzz around real estate, you might expect me to be diving in right now. But I'm actually hitting pause on buying property. Here's why. The market feels unpredictable, prices are sky high, and the timing just isn't right for me. Instead of rushing into a purchase, I'm focusing my energy elsewhere, building a stronger financial foundation and exploring smarter investment strategies. Let me share what I'm doing instead and why it's working better for me at this moment. Today we will talk about why I'm not buying real estate right now and what I'm doing instead. So before we start, make sure to hit the like button and subscribe to my channel. 1. Market conditions and economic uncertainty. One of the primary reasons I'm holding off on buying real estate right now is the unpredictable economic environment. Inflation rates are fluctuating, interest rates are rising, and global financial markets are unstable. Real estate traditionally benefits from low interest rates, which reduce mortgage costs, but with rates climbing, borrowing becomes more expensive. This erodes potential profit margins and makes monthly payments less manageable. Additionally, economic uncertainty, such as potential recessions or geopolitical risks, can lead to decreased property values or prolonged holding periods before seeing returns. In such a climate, jumping into real estate feels like navigating through a minefield with limited visibility. I prefer to wait for clearer signals before committing large amounts of capital to an asset that can be illiquid and vulnerable to market downturns. 2. Overvalued property prices. Current property prices in many regions, especially urban centers, appear highly inflated compared to historical averages and rental yields. Driven by pandemic-related demand surges and low supply, prices have skyrocketed, outpacing wage growth and rental income increases. Buying at such peak prices risks capital depreciation if the market corrects. Additionally, the price-to-rent ratio is unfavorable, meaning the cost to buy it is significantly higher than what one could expect in rental income, reducing investment appeal. This mismatch suggests the market might be experiencing a bubble, and entering now could mean paying a premium that won't be justified by future returns. I'm consciously avoiding chasing overpriced assets to protect my capital and patience for better entry points. 3. Rising interest rates and financing challenges. With central banks hiking interest rates to combat inflation, borrowing costs have risen sharply. Mortgage interest rates that were once near historic lows are now significantly higher, increasing monthly payments and the overall cost of homeownership. For investors and homebuyers relying on financing, this means reduced affordability and tighter budgets. Additionally, lenders have become more stringent with qualifying criteria, requiring higher credit scores, larger down payments, and more documentation. This makes acquiring favorable loan terms difficult and reduces leverage opportunities. Given these constraints, I find it prudent to pause purchasing real estate and instead focus on accumulating savings or paying down debt until financing conditions improve. 4. Potential for market correction. Indicators suggest that some real estate markets may face corrections or price stagnation in the near term. Factors like increased mortgage rates, reduced buyer demand, and potential oversupply in certain areas could lead to price declines. Historically, markets that experience rapid price increases often see subsequent slowdowns or drops. Entering the market during such a peak exposes buyers to negative equity risk, where the property's market value falls below the purchase price. This can trap owners and reduce liquidity. By waiting, I aim to avoid buying at the top of the cycle and position myself to benefit from more favorable pricing and negotiation leverage when a market adjustment occurs. 5. Diversification beyond real estate. Instead of putting all my capital into property, I'm diversifying my investments across different asset classes such as stocks, bonds, and alternative investments. Real estate is traditionally illiquid and requires substantial capital and management effort. Spreading investments across liquid and varied assets reduces risk and enhances flexibility to respond to market changes. For example, equities provide growth potential and liquidity, while bonds offer income stability. Alternative assets like REITs or crowdfunding platforms allow exposure to real estate without the burdens of direct ownership. This balanced approach aligns better with my risk tolerance and financial goals at the moment, allowing me to adapt quickly and capitalize on emerging opportunities beyond the property sector. 6. Focus on building cash reserves. Building a substantial cash reserve is a key priority while I'm not buying real estate. Cash provides flexibility, security, and the ability to act quickly when opportunities arise. In uncertain markets, Having liquid assets ensures I'm not forced to sell investments at a loss to cover unexpected expenses. It also positions me to capitalize on future real estate deals when prices become more attractive. Furthermore, cash reserves help mitigate risks associated with sudden income loss or emergencies. By focusing on increasing my savings and emergency fund, I'm strengthening my financial foundation, which will serve me well both in real estate investment and overall financial health down the line. 7. Enhancing personal and professional skills. While waiting to buy, I'm investing time and resources into improving my knowledge and skills related to real estate and finance. This includes reading market reports, attending webinars, networking with industry experts, and studying investment strategies. Enhancing my understanding of market dynamics, financing options, property management, and negotiation tactics will help me make better decisions when the time comes. Additionally, I'm exploring skills in digital marketing, data analysis, and personal finance, which complement my investment pursuits. Continuous learning prepares me to spot trends, evaluate deals critically, and manage properties efficiently, thereby increasing the likelihood of successful outcomes when I eventually purchase real estate. 8. Exploring alternative real estate investments. Instead of direct property ownership, I'm exploring alternative ways to invest in real estate that require less capital and lower risk. Real estate investment trusts, REITs, allow me to invest in diversified real estate portfolios with liquidity similar to stocks. Crowdfunding platforms enable fractional ownership of commercial or residential projects, spreading risk among many investors. These alternatives provide exposure to real estate market gains without the hassles of property maintenance, tenant management, or large down payments. Additionally, these vehicles offer greater diversification within the real estate sector itself. By engaging in these strategies, I maintain real estate exposure and potential income streams while avoiding the downsides of direct ownership in a volatile market. 9. Strategic patience for better opportunities. Above all, my decision to avoid buying real estate now is a commitment to strategic patience. Real estate investing demands timing, research, and disciplined capital deployment. Rushing into purchases during uncertain or overpriced markets often leads to suboptimal results and regret. By waiting, I'm positioning myself to enter the market under more favorable conditions, lower prices, better financing, and clearer economic signals. This patience also allows me to preserve capital, reduce risk, and accumulate knowledge. In the meantime, I'm focused on strengthening other financial areas and keeping a close eye on market trends. When the right opportunity arises, I'll be ready to act decisively and confidently, maximizing my investment potential. But if you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.